Hello, good afternoon, everyone. This is David Levy, one of the partners here at Diversified, and I'd like to welcome you to our next installment of our Wealth Webinar Series, Year-End Tax Planning. In a moment here, I'll welcome Dean Mioli. Dean serves as the Director of Investment Planning for the SEI Advisor Network. In his role, he is responsible for supporting the delivery of advice-driven asset management solutions for SEI's advisors and their clients. Per usual, we'll look to keep this about 30 minutes to get you back to your day. And for today, to make this as efficient as possible, we will not be taking any questions. However, if you have any questions, please reach out to us afterwards, and we'll be sure to get them answered for you. With that said, Dean, show is yours.
Thank you, David. Good afternoon, everyone. Let's get started. Here's our agenda. We're going to touch on the Secure Act. This is very important legislation working its way through Congress. I want to make sure you understand that it is not law currently, but we do expect this to be addressed in Congress next year. We're going to do a quick review of the U.S. tax system, touch on AMT. Good news there. The returns that we've been reviewing for our advisors this year, not one client has been in AMT. So it's really almost a thing of the past. We're going to do a quick review of cap gains and losses. It's been an outstanding investment year all across the board. Losses are hard to come by right now. We'll do some itemized deduction planning. And then at the end, we are going to talk about a planning meeting checklist, something you might want to work through with Diversified and your financial counselors. So let's take a look at the Secure Act and some of the big changes there. Now my arrow button is not working. So let's see what, oh, there we go. I'm going to touch on the last provision here, which is the one that is absolutely the most important. One thing is they are going to put out the required minimum distribution age that's currently 7.5 to 72. That's one of the provisions. Now, this has passed in the House. It's been bogged down in the Senate, but we do expect this to be addressed next year. Timing is totally uncertain, though. The last thing here on this slide that's important is the stretch provisions of the IRA. As we know it today, could go away. Right now, a non-spouse beneficiary, let's say I inherited an IRA from my dad, I could take the RMDs over my lifetime. That is known as the stretch IRA. For a non-spouse inheriting with the Secure Act being passed, I will no longer have that ability as a non-spouse to do it over my lifetime. I will be restricted to no more than 10 years of getting that payout. How I take it over those 10 years is totally up to me, but the most I can stretch it for is 10 years. That's a huge change that's coming. Now, for a spouse, when a spouse inherits an IRA, they have special provisions. They could treat it as an inherited IRA, which I would normally recommend if they're under 59 and a half, just in case they need to take money out of the IRA and not be subject to a penalty. And they always have the ability, even if they start as an inherited IRA, to convert it to their own IRA. So keep an eye on this legislation. Diversified will be doing so, and so will I. And there are things that can be done to reinstate the stretch by using a charitable remainder trust. Little heavy for today's conversation, but we could get into that on a specific client situation. Next slide, please. I don't think my arrows are working. Okay, quick review of the tax brackets. One of the top tax planning tips I have is Roth conversions. And for us, in my mind, if you're in the 10, 12, or 22% bracket, Roth conversions to me are an absolute no-brainer. That is a very low tax rate. Do a Roth conversion today, pay some tax potentially. It's tax-free forever. That's a pretty good deal in my mind. Not only will you not have to pay tax if you take money out of an IRA, a Roth IRA, but when it's inherited, they won't have to pay tax on those Roth IRA distributions either. And I was just talking about the Secure Act, where there could be a limit on the number of years you could take RMDs as a non-spouse. This would not stop me at all that Secure Act would pass. I would still be thinking about Roth conversions. One thing about it is the best thing you could leave your kids or grandkid is a Roth IRA, not a traditional IRA, which is a very tax inefficient asset. And another thing is when you have a Roth IRA, of course, that is not subject to RMDs if you're the original owner. Now, let's take a look at some of these brackets. If you look at the married filing joint column, 24% bracket, go across, you could be up to $321,000 of income and still be in the 24% bracket. That's amazing. That's amazing. And these rates, as you see them today, will be around next year. But we do have an election next year, and depending who wins, the tax could be right back on the table, and there could be changes. So I would take full advantage of these rates as you see them today, because they might not be here in the very near future. Next slide, please. Now, I show this slide really just for fun. It is our tax system on one slide. It's for the 2019 tax year. It's all color-coded. As you can see, we have our own type of income here, taxable income, earned income, AGI, which stands for adjusted gross income, a very important number on your tax return. We have ordinary tax rates going from 10 to 37%. Of course, we have special tax rates for long gains and qualifying dividends. They're tax favored. We have wage taxes, self-employment taxes. In the purple there, you have the net investment income tax, which when you have AGI greater than 250 as a married couple, for instance, you're subject to this 3.8% surtax on that investment income. And on the far right, we have AMT, which again, due to the tax law change in 2017, 99% of Americans don't have to worry about this anymore. It's a very rare situation where someone would find themselves in AMT. And the reason why is the way they changed how you itemize deductions and how they changed the way they compute AMT. It's just not applicable now to 99% of Americans. Next slide, please. Okay, for this year, we have a standard deduction of $24,400 for a married couple and $12,200 for a single filer. What this means is you file your tax return, you don't have to prove one penny of your deductions. The government will just give you, depending on your filing status, the standard deduction, which now essentially incorporates your personal exemptions to some extent, which may not be exactly accurate when someone has a big family. But in any case, this is what you get. Now, if you're going to want to itemize your deductions, you're going to have to hurdle these numbers to itemize. And with the tax law changes that they made back in 2017, from the IRS, I have read that over 90% of Americans now no longer itemize. They're just going to take this standard deduction. Now, that is simplification in some ways. You don't have to do the Schedule A. You don't have to count up all your tax payments and your mortgage and your charitable contributions, etc. So that is some simplification. But if you want to itemize, and we're going to cover this, you're going to have to be a little more clever on how you package your itemized deductions. And of course, if you happen to be over 65 or blind, you can get some add-ons to that standard deduction. Next slide, please. All right, long gains. There is some complexity out there with long gains. This has been a terrific market everywhere you look. Fixed income with interest rates coming down. There's been a lot of appreciation in bonds. I don't need to remind you about how well the equity markets are doing, not only in the United States, but around the world. So there's big gains out there this year. What I'm showing you here is three tax brackets, 0, 15, and 20 tax rates, and tax brackets that correspond to single and married filing joint. Now, that's not quite the whole story because, as I mentioned about that Medicare surtax, that does kick in on AGI. So we really have four long-term capital gain brackets, 0, 15, 18.8, and then 23.8. I want to point you out, so a couple of things. One is, look at that 0% bracket. So a married couple with taxable income this year below $78,749, all your long gains, if your tax bracket is below this number, all your long gains and also your qualifying dividends would be taxed at a 0%. So let's say you had $50,000 of taxable income this year projected. You could harvest $28,000 of long gains. Stay under that number. That's important. And all of it would be totally federal tax free. Not a bad deal. So there's some really good tax planning in these lower brackets. Now, if you can find losses in your portfolio, which, by the way, are pretty hard to find these days because we've had good markets really for about 11 years now overall. But if you have losses, I would suggest taking them if you have gains this year. You're allowed to use your losses against your gains, and if you happen to have losses in excess of your gains, you're limited in every year how much you can take of losses in excess of your gains. So it's in 3,000 of losses in excess of your gains. And then for federal tax purposes, if you can't use a loss in a current year, you get an indefinite carry forward. So it carries forward to future tax years, but you can use it then. Now, if there's any Pennsylvania or New Jersey residents on the phone, those two states do not have carry forward provisions. So if you have losses this year, find something to sell at a gain to marry and use those losses because there are no carryover provisions for those two states. And that's extremely important for the New Jersey residents, which has a very high tax rate relative to, say, let's say Pennsylvania. Next slide, please. So, that was one too many. So, just a quick reminder, if you're in these lower brackets, 10 or 12, you want to gain harvest. Once you get over 12% tax bracket, you want to look to lost harvest as best you can. Okay, and what the number we would like to strive for is when you look at your capital gain and loss line from your Schedule D, you want to get to that minus 3,000. That means you've harvested losses in excess of your gains. And if you're in a top bracket, let's say 37%, harvesting 3,000 in losses in excess of your gains just saved you $1,000 in tax. That's not bad. Next slide, please. Okay, let's talk about medical expenses. If you want to deduct medical expenses on your Schedule A, you need to hurdle 10% of your adjusted gross income. That's a pretty high hurdle. So as an example, $100,000 of adjusted gross income, you need at least $10,001 to deduct any medical expense, because 10% of $100,000 would be 10 grand. So my question to you is, if you've had incurred medical expenses this year, you should get a tax projection done to see where your AGI is falling and see how close you are to actually deducting medical expenses. Because basic tax planning says accelerate deductions in the current year and defer income into future tax years. That's general rule. Now, specifics do get in the way of that, but that's the general rule. Point is, if let's say your AGI was $100,000 and you're at $9,000 at medical expense, well, there could be some things you could get done before year end. Okay, maybe you need cataract surgery. Maybe you could make another health insurance premium payment. Maybe you can get your maybe you're waiting to get a crown done or something. Whatever the case may be, there's no point to getting to the goal line and not getting over. So if you're close to being able to deduct your medical expense, pull those deductions into this year and get the benefit of deducting some medical expense. There's no reason to get to $9,999, where if you just incurred another $1,000 of medical costs, which we were going to do anyway, just early next year, push it into this year. And here's several examples of what you could do. Next slide. And by the way, if you want copies of this slide, Diversify can send these to you. These have been end client approved. Mortgage interest, of course, there's new limits now on new mortgages for first and second mortgages, first and second homes, combined of $750,000. If you do a home equity line of credit now, it's no longer deductible unless it's for home acquisition, buying a new home, or home improvement. Okay, if you went out and bought a new car and you wanted to use a home equity line of credit to finance that car purchase, that would not be deductible interest anymore, and nothing got grandfathered in either. State and local tax, SALT, the acronym for that, is now limited to $10,000. This was a huge change. Before there was no limitation, so we would see tax returns where that number was 10 times that amount, $100,000 in real estate and employment taxes, etc. And I think a lot of people were under the misconception that they were actually getting the benefit of those taxes paid. But before the tax law changed, we had AMT, the alternative minimum tax. And it's interesting that with this dual tax system, some things that were deductible for your regular tax calculation were not deductible for the AMT calculation. And taxes paid was one of them. So even though people thought they were actually getting a tax deduction, when you were a New Jersey resident or California, New York, or Massachusetts, to give you some examples, they weren't getting any benefit from these taxes because they were in AMT. So, but for most people, the fact that this is getting limited, what's making this happen is they're not itemizing. They're going to wind up taking the standard deduction because this was a huge expense that now is limited to 10 grand. Before there was no limit, and most people were easily able to itemize their deductions. Not anymore. Next slide, please. Charitable giving. Charitable giving has become so important if you're looking to actually itemize your deductions. It's become the fulcrum of whether you're going to itemize or not. Now, you have choices. One is you could always give cash to public charities. And with charitable deductions, there are limitations on how much you can deduct in a given year. For cash, it's 60% of your AGI number. Again, that's why this AGI number is so important. So many things are keyed off of that number in your tax return. And if you can lower your AGI, you're really doing some good tax planning. Now, if you give appreciated securities, which I'm sure you have plenty of in your portfolio, and I would suggest almost always this is going to be the better thing to give to charity. It's a 30% of your AGI limitation. So if your AGI is $100,000, the most you conduct in a given year to charity for appreciated securities would be $30,000. Let's say you give away $40,000 in appreciated securities this year. Well, you took $30,000 this year, and then $10,000 would carry forward to next year. So whatever you can't use this year, you have a 5-year carry forward. And if you're making big contributions to your favorite charities, that's a great time to pair that with a Roth conversion. Bringing two tax planning ideas together can be a real tax savings powerhouse. Now, when you give appreciated securities to a charity, you help out in two ways. One is you got out of the gain, because when you give the appreciated securities to your favorite charity, you're not going to pay tax on that gain. Neither will the charity because they're tax exempt. And on top of that, you get a charitable deduction. So you win two ways. You get out of the gain, plus you get a charitable deduction. Doesn't that make a lot of sense? Next slide, please. Now, another idea to give to charity, for those of you over 70 and a half, and you must be actually over 70 and a half, not the year you turn 70 and a half. This only applies if you're actually over 70 and a half. You can actually donate your required minimum distribution to charity. This is called a qualified charitable distribution. And this is a really important thing because, again, you're over 70 and a half. You're probably in a situation where you don't have a mortgage anymore. Your state and local tax is limited to 10 grand. Most people don't get to take a medical expense, right? So here, you're a married couple, you got to hurdle 24.4 standard deduction, and you only have $10,000 of state and local tax. And let's say you give $5,000 a year to charity. Well, you're woefully short of itemizing. You need to get to 24.4, and you're only at 15. But you do give to charity. So what you can do is you can donate some of your RMD or all of it, up to $100,000, which could be considerably more than your RMD, to charity. And if you do this, you don't have to report what you donate to charity via your RMD as taxable income. In fact, it does a few things. It lowers your AGI and lowers your taxable income. And this is really a tax smart idea because you weren't going to get the benefit as an itemized deduction, but here you get something better. It lowers your AGI. Now, if you decide to do this, make sure your tax preparer knows that you do a QCD because there's nothing on the 1099 form that indicates that you've done this. It's very important they know this. Otherwise, they're not going to record it right on your tax return. Very important. The other thing is that if you're going to make this donation via your RMD for 2020, next year, do it first thing because there's ordering rules when money comes out of an IRA, and the first thing that comes out is an RMD. So if you are going to do a QCD, do it early in the year. This way, whatever you do as a QCD in January will reduce the amount of RMD that you'll have to report on your tax return. Now, this could be done by electronic transfer. SEI can certainly make that happen. If you actually want to present the check to your charity, we would have to make the check out to the charity directly. It can't maybe be made out to you, because if it's made out to you, you've defeated this whole strategy. The check must be made to the charity. So if you're over 70.5, you're charitably inclined, struggling to itemize, this is your answer. Next slide, please. Okay, lifetime gift exemption. Currently at $11.4 million per person. Huge number. 22.8 between a married couple with portability. 99% of Americans do not have $22 million in estates. This doesn't happen. Okay? The annual gift exclusion is $15,000. If you're charitably inclined to your family, this is something you might want to look at. You can give away appreciated securities to people in a lower tax bracket. Estate planning is still important, and it's all about step up, getting stepped up basis. Let me give you an example. I've been working at SEI for 14 years now. I bought some SEI stock back in 2008 and 9 when it was a single-digit price. I don't know if you looked recently, but we're about $65 a share. Over the years, I have been donating, or not donating is not the correct word, I've been gifting SEI stock to my father, who's obviously much older than me. Now, when he passes on, and we know that's inevitable, it's written that he's going to gift that stock back to me. So I've been hanging on to the stock for years, gifting it to my father. He has it now, but when he dies and gives it back to me, I get a full step up in basis. So I have a significant gain in these positions, but when I get it back from my father, I will have a zero tax bill, zero. Because the stock, I bought it at 8 and gifted it to my father. Now it's worth 65. When he dies, the basis is reset to 65. I've just got out of a huge tax bill. This is Code Section 1014E. The only requirement here is that my father has to live more than a year after I give it to him. If he gives it to my sister, he doesn't have to even live a year. Doesn't even have to have that year requirement. It's only if he gives it back to the person who gave it to him. So when you're thinking about gifting, it can work both ways, not only to people younger than you, but it may actually be very advantageous to give something to someone older than you. Think about that. Next slide, please. All right, little review on investment taxation. Next slide. We kind of touched on this, so I'll just take a minute. Taxes is a huge expense when it comes to investments. Top tax rate on inefficient investments like taxable interest income, which includes like CDs, short-term capital gains, non-qualifying dividend income, 40.8 top tax rate federally. There is some tax-favored income out there, 23.8 on qualifying dividends and long gains. That's the top tax rate. Actually, the lowest tax rate on that could be 0 if you're in the 12% tax bracket. And then, of course, there's tax-free income as well. Now, when it comes to municipal bonds, they still make a lot of sense for people. Now, if you're in a low-income tax state like Pennsylvania, I don't think it doesn't really make sense for sure to use munis, and probably you're in like the 32% bracket. That's a definite. You're definitely going to do it. If you're a New Jersey resident, Delaware resident, all right, 24% federal, you have fairly high state income taxes there. You can take that into consideration, 24% federal, including state tax. You're definitely looking to do munis in your non-qualified accounts. And the last line is the most important. Pre-tax returns rarely equal after-tax returns. And the name of the game is maximizing after-tax returns, because that's what gets compounded, and that's everything in the investment world is my compound returns. Next slide, please. This is just an asset location priority list. Diversified works with you in two ways. They work with you in your asset allocation, how much goes into stocks and bonds and commodities and these types of things. And then they're also looking at your accounts from a tax perspective. So your non-qualified accounts versus your IRA accounts. Certain asset classes are better housed in your IRA account. For instance, high yield bonds, emerging market debt, TIPS, active equity managers, commodities. These are very inefficient asset classes from a tax perspective. But if they're in an IRA account, they're sheltered from tax. You get that tax deferral, or it's a Roth that's tax-free. Not good to have in your non-qualified account. Look at the top of the list: muni bonds, tax managed equity, tax advantage preferred stock. Things like that are much more suited for your non-qualified account. So you minimize that tax bill and you get more compound growth. So take that into consideration when you're working through your asset allocation. Asset location is important too. Next slide, please. All right, let's review the tax meeting checklist. Next slide. Now, these are just some ideas for you to think about, and you could almost make this a 2019, 2020 planning checklist, because you might not get in to see diversified before year end unless some of the things that we've talked about today are really striking a bell with you and you want to get something done before year end, because most tax planning has to be done by December 31st. There's very few things you can do after December 31st other than, let's say, an IRA contribution. So if there's major events coming up, not for 19, but for 2020, Diversified needs to do that. It's always a good idea to review beneficiary designations and update accordingly. Okay? Make sure you're taking your required minimum distributions. Okay? Especially now that we've talked about the qualified charitable distribution. Take that into consideration with your RMDs for next year. Okay? For some of you who are still working, flexible spending accounts. The deadline for some are at the end of the year. Some have gotten extensions. Here at SEI, we have until like March 15th to use up our FSA accounts. Make sure you're doing that. Don't throw that money away. Make sure you use up that entire balance. And I believe the 2020 number is $2,750. So you'll probably need to re-up if you haven't done already for next year with your employer. Next slide. Okay, we talked about estate and gift planning. Again, use up that $15,000. You can give anyone $15,000. There's other ways to give too, not just through giving them appreciated securities or cash. Direct payments of medical bills, direct payments of college tuition. You don't even that would all be considered a tax-free gift. Okay, think about that. So there's other ways you can help people out. Okay. As I mentioned in point number 2. And consider other options for using trust and other vehicles to benefit family and charities. If you're sitting on big gains in real estate, in portfolio gains, and you have some trepidation about selling those things because there's a big tax bill, there's certain types of trusts. I'll name one, like a charitable remainder trust, which are extremely powerful in taking away that initial tax bill. You get a charitable contribution when you set these up, which then can help you, let's say, with a Roth conversion. You'll get a tax-favored distribution from the charitable remainder trust. For instance, let's say, as long as you and your spouse are alive. And then after you both pass on, which could be 30 years from now, this is an example, whatever's left, if any, would go to your named charities in the document. So if you have situations like that, appreciated securities, real estate that you're looking to sell, and you got a big tax bill ahead of you, you should be thinking about CRTs. On the flip side, if you have something that you have already sold for this year, it's a little late to do one of these trusts now in the year. But if you, on the other side, let's say you have a big lottery winning, you had non-qualified stock option exercises that you're waiting to do in January. Again, good tax strategy, pushing come into another tax year. You might want to look at the charitable lead trust. Grantor charitable lead trust is a way to maximize your charitable deduction and marry that to the income item. That's good tax planning. Now let's see if we have anything else here, or we're done with our little slideshow.
It looks like that's it, Dean. That
Okay.
was awesome. I'll tell you what, you just gave me a great idea as I was listening to that with the gifting your father the low basis stock to inherit it later in life. So even I got something out of this today. Thank you.
Well, my pleasure.
Cool. So we are recording this webinar, and we'll have it posted on our website for easy access. And as always, please feel free to share this with anyone you'd like. Also, please save the date for our next webinar on February 12th at noon, where we will be discussing a year in review and the year ahead. So with that, have a great day, everyone. Thanks for joining. And Dean, thanks for all the wonderful information, and everyone here from Diversified wishes everyone a happy holiday and a new year. We'll catch you on the flip side. Take care.